Good afternoon, everyone. A very warm welcome to all for today's webinar on Companies Act 2013, Accounts and Audit. We are delighted to have you all with us today for the focus session and practical insights. It's a pleasure to extend a warm welcome to our Chairman, Sir, CA Babu Ibrahim, Sir, and our Vice Chairperson, CA Preeti Savla, Madam, and today's esteemed speaker, CA Jorman K. George, Sir, and our esteemed moderator and a very senior member, CA Paulson KP, Sir. We are honored to have you, sir, with us. And I would now request our chairman, sir, to kindly address the participants and formally address the session. Thank you, sir.
Very good afternoon to all of you. I think a large number of members are joined across the country. I think as of now we have more than 1,100 participants, and more are expected to join. Probably, I'm sure this is because of the importance of the topic. The Companies Act 2013 has significantly strengthened the framework of the audit and accounts by placing transparency, accountability, and governance at the core of corporate, becoming key guardians of stakeholder confidence with sharper focus on internal controls, related party transactions, fraud reporting, and true and fair financial reporting. At the same time, the Act has enhanced the responsibility of the management and boards, making financial statements a collective responsibility rather than an audit-driven exercise alone. Or an industry must work together to ensure that financial reporting reflects not just statutory compliance, but also ethical conduct, robust controls, long-term sustainability of enterprises. I am extremely glad and delighted that today two of my best friends are here to enlighten us. The speaker of the day, C. Jomon K. George, is a past chairman of the Southern India Regional Council. We have been together in the Regional Council, and also he has been a very widely well-known speaker, especially on topics of I think he would have presented papers, or maybe more than 1,000 papers by now, I'm sure. And KP Paulson is again a past chairman and senior past chairman of the branch, Ernakulam branch of the institute, and a very strong, nearly 4 decades of experience. I'm sure these two stalwarts will make us happy learning for the next 2 hours. Over to the Nikita.
Thank you, sir. Thank you for your engaging words and setting the tone for the session. I would now welcome our moderator for this session, CA Paulson KP, sir, who is a fellow chartered accountant with over 45 years of professional experience in accountancy, law, information system, and quality management, and also held several leadership roles in ICAI and other professional bodies. Now, I would like, sir, to kindly introduce our speaker and open this session. Thank you, sir.
Respected CA Babu Kallivelil, Jomon K. George, and Nikita, and my dear friends. It gives me great pleasure to welcome you all to today's corporate webinar on Companies Act 2013, Accounts and Audit. This is a subject that sits at the very core of corporate governance and professional responsibility, and perhaps no other area under the Act has witnessed such a continuous evolution, heightened scrutiny, and increasing expectation from stakeholders. More than a decade into the implementation of Companies Act 2013, it is now evident that the legislative intent has gone far beyond mere compliance. The framework relating to accounts and audit today seeks to ensure transparency, accountability, audit quality, and stakeholder confidence, placing the audit not merely as a checker of numbers, but as a critical gatekeeper in the corporate ecosystem. From the maintenance of books of accounts under Section 128 the preparation of financial statements under 129, and the statutory framework from 139 to 148. The law has really tightened the standards of responsibility on both the company and the auditors. This tightening is not incidental or accidental. It reflects lessons learned from corporate failures, financial irregularities, and systemic risks observed over the years. The strengthening of CARO reporting, enhanced auditor reporting under Section 143, mandatory disclosures of internal financial controls, fraud reporting obligations, and the expanded role of audit committees are all indicators of a clear shift. The audit report is no longer a procedural document. It is a governance document. Recent years have further reinforced this shift. Amendments and regulatory actions have elevated expectations around audit documentation and professional skepticism, strengthened the audit independence, eligibility, and rotation norms, expanded the oversight role of regulators, including increased focus on audit quality review and enforcement, emphasis on the true and fair view, not in form, but in substance. For us as chartered accountants, this has resulted in a fundamental change, not only in how audits are planned and executed and documented, but also how audits are defended when challenged. The profession today operates in an environment where technical correction alone is insufficient. Judgment, ethics, become equally critical. NFRA's 2005 inspection across 12 reports have exposed gaps in independence, related party audits, and lack of controls. 19 firms and 84 CAs are penalized. Against this backdrop, today's session assumes great relevance, covering the subject of accounting and audit under Companies Act 2013 in a limited time is undoubtedly challenging, but also immensely valuable in the context referred above. Because of what is required today is not repetition of sections, but interpretations, applications, and practical insight, especially in the light of recent amendments and regulatory expectations of the government and stakeholders. We are fortunate to have with us CA Jomon K. George, our past SARC chairman, as the keynote speaker, who brings not only technical mastery of the law, but also rich practical experience in dealing with complex audit and reporting issues. CA Jomon K. George, a highly respected senior chartered accountant with over 33 years of professional experience in accounting, audit, and corporate consultancy. He is the founder and managing partner of JVR Associates, a multi-partner firm specializing in corporate audits and consultancy. As Babu sir has mentioned, he is also served as a chairman of Southern India Regional Council of Institute of Chartered Accountants of India. He is also a seasoned academic and professional speaker. He has taught over 10,000 CA students, delivered 1,000+ presentations on accounting, auditing, and corporate audit, and served as a member of the Auditing and Assurance Standard Board of ICAI. He is also a peer review trainer and has served several leadership and advisory roles across professional, academic, and social institutions. With this brief introduction, I now have the privilege of inviting our keynote speaker to take us through this vast and critical subject. I request all participants to engage actively and make the most of the expertise being shared today. Thank you all, and over to the speaker.
Paulson sir, your video is not visible.
Pardon?
Either it
The
is
video is not
off
on.
or on.
But was I audible?
Yeah,
Yeah,
you're quite
over
clear,
to
sir. It's okay. You please switch on the video.
over to the
Yeah, thank you. Good
Hello.
afternoon to all of you. The very respected chairman of the CLCGC and a very dear friend and a very senior colleague, CA Babu Abraham Kallivalil, CA Preeti Savla in absentia, the vice chairperson. She's also a very dear friend. We are counterparts in 2019-20 when I was chairman of the Southern region. She served as the WIRC chair, and we still have a very warm, close relation, friendship, and very happy that she's serving CLCGC as a vice chair under the able leadership of CA Babu Abraham. CA KP Paulson. This is predominantly a Kerala show. Three of us are from Kerala, but learning transcends regional differences, and I'm extremely happy that Paulson sir is moderating this session. I took my baby steps in tax practice, holding the able and strong hand of CAKP Paulson, and he will keep a very good friendship and professionally as well as personal friendship. And his son is also CA's second generation action. We always look forward to him as a source of support. And Nikita and the entire team at the CLCGC have done a great homework in line with the thinking, progressive thinking, and the spirit of the captains of the committee. And very, very respected senior members, I'm happy to note that we have 1,000 plus participants, though online. But this is Core Learning, it's a web series organized by the CLCGC. It's a need of the hour, and it's quite fitting and proper that CLGC has at this point of time. We can say off season, we are completed the busy season. Some of us are taking long breaks, all of us should. But it's also a time for learning and gearing up for the ensuing days where the challenges, as pointed out by the chairman and the moderator, said that the profession is under the lens than ever before. We have seen with some disfavor, even the very root of our good intentions, serving the nation as partners in nation building and being high priest in the religion of financial discipline is being suspected and doubted. It's very painful. At the same time, we cannot but essentially cope up with the challenges which are emerging. And we have weathered more difficult challenges, so we'll move on. I'm a great optimist from the view perspective of the professional, the future of the profession, as well as the future of the individual members as we gear up and diversify into the newer areas of practice and finding new ways of supporting the entrepreneurs, the business world in creating value for the organizations and therefore effectively the nation building. So with a deep sense of gratitude to CA Babu Abraham Kallivalil and the entire CLCC team for having me here for this program on Company Audit 2013, provisions relating to accounts and audit. I would like to move on to the specifics of the presentation. And like Paulson sir rightly said, the audit report is a governance document. So there are a lot of onerous responsibilities, huge responsibilities on the profession and the chartered accountants individually as practicing CS, as they say, as we do the attestation functions, all very important. With this introduction, once again, with a big thank you, let me move on to the specifics, sharing the PPT with you. Nikita, are the slides visible?
Yes, sir, it's visible.
it is visible.
Yeah, thank you. So, Companies Act 2013, Accounts and Audit. These are two very important chapters. In fact, Accounts is a standalone chapter. And sequentially, the following chapter is Audit and Auditors. The first chapter is chapter 9, which we are going to discuss on accounts of companies, covering section 128, which was pointed out by the learned moderator. 128 going up to 138. 138 is internal audit, but it's still included in this chapter. There are two things which are not strictly related to accounts also included in this chapter. 132 NAFRA and 135 CSR, Corporate Social Responsibility. So it's a very, very important chapter, and the sections are very demanding and quite focused in the sense that from our early days of learning, we always know that corporates are characterized by divested ownership and management.
ownership of large stakeholders, large number of shareholders and stakeholders, whereas the management is entrusted with a handful of people, the elected representatives who should act as stewardship with a lot of stewardships as stewardship, showing stewardship to the shareholders, the entire stakeholders, the board of directors, and therefore it is very important that there are very specific, clear-cut provisions on financial discipline and good governance in accounts and audit. So we are now going to discuss in the next 1.5 hours or so, dissect these sections threadbare, and then and see what are the things which are to be understood and not just understood and learned in sessions like this. It should be applied at the work desk. It should become part of the work DNA of every practicing chartered accountant. While saying this, I should also say that many of the chartered accountants have moved away from corporate law and corporate law practice, just doing the audits and things like that. And we have, to an extent, pledged the corporate law practice to company secretaries. But I think the time has come for us to come back, and there are a lot of corporates being formed. The law is being amended. This Act is 12 years old. We still call it the New Companies Act. It is 12 years old, and we're still carrying it as a baby, but it's still evolving. There are changes which are happening, not without reason. There's a huge thrust on enhancing ease of doing business. So we cannot have a draconian provisions in the corporate law that governs a country which is so aspiring, which is the fastest moving and fastest growing large economy in the world, and poised to become the third largest soon, and just China and US ahead of us. So that's the aspiration of the nation. And we as professionals who have supported this the entire process of more than 75 years, we should gear up. And therefore, it's very important that the lawmakers also, converges with this kind of a thinking and spirit and makes this act simpler, more rationalized, and that is the way it is moving now. So we had a corporate law committee which has come out with suggestions. So it's very important that we enhance the ease of doing business and reduce the cost of compliance, make things easier for people who want to invest in India. When we advise intending investors from abroad, bringing FDI into the country, much needed FDI into the country, the provisions have to be simple and with clarity on with very little ambiguity. That's the spirit of it. So with that, we'll move on to the specifics. 128 is books of accounts. We'll have, as I said, a threadbare discussion, and therefore we'll have this read. Every company shall prepare and keep at its registered office books of accounts and other records, relevant records, and financial statements for every financial year that gives a true and fair view of the state of affairs of the company, including that of its registered branch office and offices, and explain the transactions affected both at the registered office and its branches, and such books shall be kept on accrual basis and according to the double entry system of accounting. This is a very, I would say that a thick, dense thicket of a section contains so many things. It talks about true and fair view of the state of affairs of the company. Proper books of bookkeeping. Bookkeeping, we call it. 128 is about bookkeeping. It has become so very demanding that capturing transactions on a timely basis, classifying them, collating them, and properly making sure that they are captured properly into their accounting system. Today, in the digitized world, once they are captured and becomes part of the system, it goes like wildfire and a wild blaze, and it goes everywhere. It just goes and gets parked in your P&L, in your balance sheet, in your cash flow, in your MIS reports. Therefore, that's very important that accounts are kept properly. And it has to be kept on accrual basis. Accrual is part of the, accrual is part of the statute book law. Accrual is an accounting assumption. When you look at Accounting Standard 1 disclosure of accounting policies, it talks about three things as accounting assumptions: accrual, going concern, and consistency. So in the financial statements, when we analyze financial statements, many of the corporates and chartered accountants report on accrual basis, which is redundant. And today it is mandatory under the company. Even under the earlier Erstwhile Act, I think it was section 208 on books of accounts, where it said that it had to be on accrual basis and double entry system of accounting. This is very clear. So that is going on, provided that all or any of the books of accounts aforesaid and relevant papers may be kept at such other place other than the registered office under due notice to the registrar of companies. That's an enabling section. If there are technical problems, the registered office and the corporate office could be different, or the hem of and the huge volume of activities could be happening elsewhere. So it can be at a place other than the registered office under due notification to the registrar of companies. The company may keep such books of accounts, other relevant papers in electronic mode in such manner as may be prescribed. So we are slowly going away from the hard copy mode and moving into the electronic mode, the digitized, and we have a lot of new accounting softwares, conventional tally, all those things were there. And Soho is making a huge, revolutionary change in the scape of accounting, digitized accounting. There are other customized many softwares which some of us are using and strongly advocating. And when electronic mode is in the news quite over the last 2 years, this is quite in the news because if you read that with Rule 3 of the company's accounts rules. Yeah, when I mentioned, I forgot to say the sections are 128 to 138, and they have to be read with the company's accounts rules 2040. That's why experts say that Companies Act 2013 is a delegated legislation because even some of the definitions, if you ask me the definition of a relative, half of that is found in the act and half is found in the rules. So you need to be having both the rules and acts held together and read together to make sense out of what the law really intends to. And Rule 3 of the Companies Accounts Rules, there is a reference here. It says that the books of accounts and other relevant books and papers maintained in electronic mode shall remain accessible in India at all times so as to be usable for subsequent reference, provided that for the financial year commencing on or after the first day of April 2023, which was deferred by 1 year, every company which uses an accounting software for maintaining its books of account shall use only such accounting software which has the feature of recording audit trail of each and every transaction, creating an edit log of each change made in the books of account along with the date when such changes were made, and ensuring that audit trail cannot be disabled or tampered with. Tampered with is my addition. So this is verbatim what Rule 3.1 of the Companies Accounts Rules 2014 says, and it's in pursuance of this, in compliance with that, we have addition, the same amendment has been made in the company's audit and auditors rules also, where in the auditor's report, we under the other legal and regulatory requirements, we are now reporting whether the accounting software used as a feature of audit trail and whether that has been tampered with and all that the things are required to report. This is very, very important to be taken note of. And where a company has a branch office in India or outside India, it shall be deemed to be complied. It shall be deemed to have complied with the provisions if it keeps proper books of accounts at the branch and periodical returns are sent to the registered office or wherever, as we have seen in subsection 1, if it is periodical returns are sent to the regional registered office or the head office, as the case may be. Books of accounts, this is about retention that shall be open for inspection at the registered office of the company by any director during the business hours, and in the case of financial information maintained outside the country, copies of such financial information shall be maintained and produced for inspection by any director subject to such conditions as may be prescribed. This is an enabling clause for the directors who may not be actively involved into the day-to-day operations of the company, but still would like to, at some point of time, refer the books of accounts, to have access to the books of accounts, examine the books of accounts for legitimate reasons. The books of accounts of the company relating to a period of not less than 8 financial years. Immediately, there is a retention period. This we are now reporting for audit trail also, where the company had been in existence for a period of less than 8 years. Then, in respect of all the preceding years, together with vouchers relevant to any entry in such books of accounts, shall be kept in good order. Now we have gone to a digitization as advanced to an extent where we have companies, we have a company, US subsidiary of a US company. There's hardly any paper. So it be all digitized documents, even the vouchers supporting documents are scanned and uploaded. And we do not have the kind of physical files, the thick box files containing voucher files, cash voucher file, bank voucher, that is slowly disappearing. But we should essentially use more of computer-aided audit techniques to make sure that we are able to examine, though not physically, examine what is really relevant, and all the transactions and supporting documents are made available for auditing and all the verifications that we do. So this is about the books of accounts, so section 128. Consequential, the next sequential section is financial statement. Now, why have used the term financial statement? The caption of the section. The financial statement shall give a true and fair view of the state of affairs of the company, comply with accounting standards. There's not a trust on accounting standards. It's mentioned in two places, very strongly and very clearly mentioned about the comply with accounting standards, notified under section 133. We are going to that C section soon, and shall be in the form or forms provided in different class of companies in Schedule 3. So 129 is the section through which we travel to Schedule 3. No schedule of the act we can jump in directly. It's always through a section that we travel. For example, 135 CSR tells us the eligible activities for CSR in Schedule 7. So that is the route we take. Now, comply with accounting standards. Let me take 2 minutes of your time. That Companies Act gives a lot of thrust on accounting standards. And the accounting standards are mandatory documents. And we have not only just accounting standards, they should also say Ind AS in applicable cases. Listed companies and companies having net worth of 250 crores or more are under the Ind AS regime. Other smaller companies are still under the accounting regime, the accounting standards, which we are more familiar with. But in the listed space today, we have moved over to the Ind AS regime, where the practices are closer to IFRS. IFRS minus carve-outs will give us Ind AS, and therefore that's how it is. And the format is given in Schedule 3. As all of you know, there are 3 divisions: Division 1, Division 2, and Division 3. Division 1, accounting standards companies. Division 2, Ind AS companies, and Division 3, NBFCs. So the formats are very important. We always talk about substance over form, but then there is always a thrust of form over substance also. In the main body of the auditor's report, what is that we are saying? The financial statements give all the information required by the Companies Act 2013 in the manner so required. It also talks about the presentation of financial statements sensibly in compliance with Schedule 3. Recently, I had an opportunity or occasion to examine 2 balance sheets. One was for advising them on a restructuring. 2 was for doing a business evaluation. So historical information, 24-25 audited balance sheets, we call it. And I found that audited by firms which have some experience, senior chartered accounts were involved. Not to discount on the capabilities of anyone, but then I found that the disclosure requirements, the new Schedule 3 was not referred to at all. For example, financial ratios, the aging of receivables, we don't call sundry debtors now, trade receivables, aging of trade payables, the columnar form which is required under the revised Schedule 3, aging of capital work in progress, aging of intangible under development, including expected date of completion and so on, that is not mentioned. So I did a few presentations across South India where we coined a term called company audit revisited. I think there's a need to revisit in the light of the understandings that new insights we gain through this kind of sessions. Provided that items contained in such financial statements shall be in accordance with accounting standards. Once again, they're reiterating accounting standards. Provided further that nothing contained in subsection shall apply to insurance, banking, and electricity companies, any other class of companies for which a form has been specified under the Governing Act. So this is a financial statements. Moving on, at every annual general meeting of the company, the board of directors of the company shall lay before such meeting financial statements for the financial year. Where a company has more than 1 or more subsidiaries or associate companies, it shall, in addition to this standalone financial statements, give consolidated financial statements of all the subsidiaries and associate companies. Accounting standard 21, accounting standard 23, and so on, investments in associates in CFS and so on, in the same form and manner as that of its own, and in accordance with the applicable accounting standards. Look at that again. Which shall also be laid before the annual general meeting of the company, along with the laying of the financial statement, which is a standalone financial statement. So consolidated is also a matter of reference for the AGM, and it is about for the board of directors have to essentially make sure that there is standalone financial statements laid and also consolidated if there are subsidiaries and associates. That 129, 130 is a revision reopening rather, that's not very common. So I wanted to cover the other important section. So with that 131, we're jumping on to 131. This is a very enabling section, a friendly section, where it says that if the directors of the company feels that it is not only the revision of voluntary revision of financial statements as well as the director's report. If it appears to the directors of the company that financial statement of a company or the board's report do not comply with the provisions of the section of 129 or 134, we're going to see 134. 134 is financial statements, and predominantly it is board's report. They may prepare revised financial statement or revised board's report in respect of any of the three preceding financial years after obtaining approval of the tribunal. NCLT, on an application made by the company in such form and manner as may be prescribed. A copy of the order passed by the tribunal shall be filed with the registrar. So everyone is taken into the loop, and that is how they do it. Provided that the tribunal shall give notice, it's an obligation to give notice to the central government and to the income tax authorities, and shall take into consideration any representations made by them and before passing an order under this section. Provided further that such financial statement or report shall not be prepared or filed more than once in a financial year. Ideally, this should not happen. But if a revision has to happen, a voluntary revision, you cannot make it a routine matter. You cannot revise every month or once in a quarter. What they've allowed is only once in a financial year. Provided also that the detailed reasons for revision of such financial statements and a report or board's report shall be disclosed in the board's report in the relevant financial year in which such revision is made. What can happen that previous financial statements or report have been sent out to members or delivered to the registrar or laid before the company in general meeting. The revisions cannot be very, very far-reaching. It can be only to make sure that in correction is respect of which the previous financial statement do not comply with the provisions of 129 or section 134. For specific misdoubt non-compliance with 129, that is financial statement, 134, board's report, only for that matter it can be revised and the making of any necessary consequence alteration. You cannot have a far-reaching or make major corrections, impacting corrections after it has been laid to the AGM or it has been delivered to the filed with the registrar of company. The central government is empowered to make rules so as to make the application of the provisions of this act to revision of financial statements or revised director's report. 132 is NAFRA, since that is an authority setup and not purely relating to the accounting responsibilities or of corporate accountants and that of to an extent auditors when they do the audit. We are moving on to 133. Central government to prescribe accounting standards. May prescribe standards on accounting or any addendum thereto as recommended by the ICAI, constituted under Section 3 of the ICA Act, in consultation with after examination of the recommendations made by the National Financial Reporting Authority. Yeah, so we have being the prescription is the central government recommended by the Institute of Chartered Accountants of India. As of now, not just recommended, the formulation, the very preparation of the accounting standards are being done, and I'm hoping that will continue to be done by ICAI, because in the sphere of standards and auditing, we know what is happening around SS 600, and where the NAFRA is flexing its muscle authority, and there are discussions, debates, deliberations going on fixing the real position of the SS 600. But as of now, as far as accounting standards are concerned, it is not just the recommendation, the formulation is also with ICAI, but in consultation with the NAFRA. So the central government has notified all the accounting standards, and we have consequently companies accounting standards rules 2021. Some of you would remember that it was originally 2006 under the erstwhile 56 Act. And after this 2013 Act was enacted, the rules of 2006 continue to apply until we have total clarity on a comprehensive companies accounting standards rules 2021, where there's a differentiation between small and medium companies, not small companies, small and medium companies, in order to determine the applicability of accounting standards and related disclosures. And of course, some of the standards are there are partial or total relaxation exemptions to small and medium companies. So this is very, very important. And therefore, this is 133. And in exercise of the powers, the central government is in its collective wisdom, the policymakers in their collective wisdom has formulated or prescribed all the standards we have today. People ask how many accounting standards are there. So we have to say that the right answer would be we have 29 minus 2. AS 8 on R&D and AS 6 on depreciation have been fully withdrawn. So, but then they have not been renumbered. Yeah, we have AS 1 disclosure of accounting policies, AS 29 provisions, contingent liabilities, and contingent assets. In between, two of them have been deleted. AS6 was deleted in 2020, and AS 8 on related party. AS 6, when it's deleted, sensibly it was blended with AS 10, which is property, plant, and equipment. Today, paragraph 40 to 60 of the AS 10 deals with depreciation. AS 8 has been, because it's dealing with R&D, long back it has been deleted and merged with AS 26 intangible assets. The treatment, the disclosures of R&D, research and development outlays taken up by corporates. 134, I don't understand why they brought in financial statement there when we have a standalone, fully contained section 129 there. So they've made a bit of a mess here by bringing in financial statement. 134 could have been exclusively and fully for board's report. The financial statement, including consolidated financial statement, if any, shall be approved by the board of directors. Approval is something which could have been 129 itself. Before they are signed on behalf of the board by the chairperson of the company where he is authorized by the board, or by two directors out of which one shall be managing director if there is one. And so there is or, and now it's coming to and the CEO, the CFO, and the company secretary of the company. If there are CFOs, CEOs, and company secretaries, wherever they are appointed. And in the case of a one-person company, only by one director for submission to the auditor for his report there. No, this is good theory, but in practice, what happens is 33 years of practice has told me that many of the corporates, including some in the listed space, SME listed company, they do not have the internal mechanism, the internal muscle to prepare sensible financial statements in compliance with the demanding Schedule 3, in compliance with applicable accounting standards or Ind AS as the case may be. Therefore, most of the time, it falls upon the auditor to prepare financial statements. Though strictly speaking, we are prohibited from doing that. We assist. We don't take up the responsibility fully. We assist the corporates in preparing financial statements or making sure that they do comply with. We guide them and make sure that we do this. And the last part of it, the auditor's report shall be attached to every financial statement. Now, the terms like attached to will become so redundant when we are moving to a completely digitized environment. So they should say that the auditor's report is to be treated as an integral part of the financial statements. Physically attaching it and all that really does not sound good in the given circumstances we are in and we are moving forward to. So 135 is CSR, 136 is share of the right of shareholders to have information. 137 is filing with ROC. So we are moving to 138. With that 138, internal audit. Recently, I was invited by the Indian Institute of Internal Auditors for the inauguration of the local chapter here. I'm based in Cochin in Kerala. And I had highlighted this section 138, which is what institution, our ICA as well as IIA should, anyone who is involved in the audit, in the audit world, audit sphere, should sensitize the corporates with, because it has become mandatory in the Act. It was never there in the 1956 Act. Internal audit was not mandatory, but here it is. It is very important that the mandatory and the statutory auditor has a responsibility in CARO 2020, and even the earlier versions of CARO, the statutory auditor had a responsibility to comment upon whether there's internal audit system commensurate with the size of the company and the nature of its business. And in CARO 2020, one more additional responsibility is that the statutory auditor should say, and whether he has seen and referred the report issued by the internal auditors. That's quite tricky, that's quite required. And earlier it was said that to commensurate with the size, and sometimes we say improves, requires, offers scope for improvement in terms of coverage and all those things. But here is very clear responsibility. And let's see, shall appoint and look at this chartered account or cost account or such other professional as may be decided by the board. This, according to me, if I may go very candid, this is ridiculous. How can the board decide on a chartered account or a cost account, and professional as decided by the board to conduct internal audit? The board should not have been given that discretion. It should have very clearly said a CEO or a cost account, no one else. The central government may by rules prescribe the manner and the intervals in which internal audit shall be conducted and reported to the board. Now let's look at the type of companies to which is a hyperlink. The internal audit is mandatory. Every listed company, and there's a lot of listing happening on SME exchanges, the NSE emerged and the BSE's SME platform. So irrespective of SME or a main board, a listed company, every listed company, every unlisted public company having paid up capital of 50 crores or more, turnover of 200 crores or more, outstanding loans or borrowings from banks and PFIs exceeding 100 crores or more, outstanding deposits are Chapter 5 deposits of 25 crores or more at any point of time during the preceding year. For a private limited, the thresholds are slightly higher. Turnover of 200 crores as against turnover of, there also, I'm sorry, turnover is the same, 200 crores or more during the preceding year. Outstanding loans or borrowings for public financial institutions exceeding 100 crores. So these two conditions are there for private limited companies. For public limited, if paid up capital and the other deposits criteria are also there. So these are the limits prescribed for companies. So if you are fulfilling any of those, the appointment of internal auditor is mandatory. It is an onerous responsibility placed on the board of directors of the company. So that brings us to the end of chapter 9. That is on accounts of companies, read with Companies Accounts Rules 2014. Rules were framed 1 year after the 2013 Act was enacted. So 128 books of accounts, 128 financial statement, 130 we have skipped, 131 voluntary revision, 132 we have skipped, 132 accounting standards by central government, 134 financial statement and board's report. We have covered only the portion relating to financial statements. 135 CSR we have skipped and come to 138 directly internal audit. So these are the core provisions relating to accounts as far as the 2013 Act is concerned. Some CLCG, somebody there? Nikita, are you there? Is it going okay? Am I audible, clear? Watson sir, are you there?
Yes, Joman, I'm here.
Is it going okay? Can I proceed? Nikita?
Yeah.
Yes, sir.
Going
Yes,
on
sir.
very well. We can proceed.
Thank you, sir.
Is my audio visible, Nikita? Now?
Yeah, you are, sir. You are.
Earlier, there was some problem when I was delivering it, I think.
Yeah, the introduction, your video was switched off. Somehow you are not visible, but you are very clear and audible. And we are very objective presentation of the opening remarks, which made my job very easy. Thank you so much.
Thank you.
So we're moving on to
you can continue.
Yeah, we're moving on to the sensibly sequential chapter 10, which is the most important chapter according to me as far as practicing chartered accounts are concerned, audit and auditors. Covering section 139 to 148. And the allied rules are Companies Audit and Auditors Rules 2014. Right away, moving on to 139, appointment. We have a lot of confusion today around appointment. Some of the appointments are not proper. But I've seen when I was the chairman of the Southern region, when the DC hearings happen at the headquarters at Chennai, many of the disciplinary proceedings used to be, unfortunately, for ensuring that the appointment is not proper without giving the required comfort to the retiring or the auditor, the predecessor auditor, the previous auditor. So appointment, they always say that make sure that the appointment letter and the proper appointment is your passport to do an audit so that it doesn't hurt anyone and you're strictly in compliance with the good governance principles and ethical practices. Every company shall at the first AGM appoint an individual or firm as an auditor who shall hold office from the conclusion of that meeting, that's the first AGM, till the conclusion of the sixth AGM and thereafter till the conclusion of every sixth meeting. So two things here. We are starting from the first AGM. We will go back to, as we proceed, we'll come to 139.5, which talks about appointment of the first auditor. But here, one thing which is to be noticed is that the term of the auditor appointed in the AGM is 5 years, not any less. So a company which appointed us for 3 years, I said this cannot be at the fancy or at the decision of its the mandatory provision that it is for 5 years. So an appointment for a period less than 5 years is not valid, inappropriate. Earlier, when the act was enacted, there's also a requirement to ratify the appointment in every forthcoming AGM in the intervening period of these 5 years. Now that has been done away with. So auditor appointment is for a period of 5 years, and as again is 1 year, AGM to AGM, from the conclusion of one AGM till the conclusion of the next AGM in the Erstwhile Act. What is to be taken note is that during this period, the auditor cannot be removed. He can be removed. The modalities we'll see when we go to section 140. Other than that, he cannot be. The management feels that it's not good, or there is some clash of interest, or the auditor is wanting to report something very candidly, and then management is not comfortable. So he cannot be just thrown out like a curry leaf. So the provisions are very clear. This insulates the chartered account very, but unfortunately, some of the corporates where we have worked with who have been put to difficulty by chartered auditors who have not responded, who are not responsive, who are, I would also say, from a large company audit perspective, not knowledgeable enough. I would say not knowledgeable, not updated enough. Just put companies into a fix, and they have gone to the difficult route of removing them, unpleasant route of removing them before the expiry of that term. I repeat, the term is 5 years, not anything less. Before appointing, every company shall obtain a written consent from the auditor and a certificate that appointment is in order and that is not disqualified under section 141. 141 talks about qualification and disqualification. This consent we always give, and we give it once a company insists on, a company wants to appoint us as auditors. We always give this, and this is a mandatory requirement on the part of the company to obtain this certificate. The company shall inform the auditor and also file notice of appointment with ROC within 15 days, the ADT1. This is being filed. It is to be filed by the company, but most of the time we help them. And this is very, very important. Now, no listed company or class of companies as may be prescribed. Now, this as may be prescribed, you find in about more than 350. These prescriptions are found in the rules. That is where I said that it's a delegated legislation, and sometimes we need to have proper reference to the rules. Acts read in isolation can have a problem. So this is what a non-listed class of companies shall appoint an individual as auditor for more than 5 years and a firm for more than 2 terms of consecutive years. 5 consecutive years. Now, this is how the audit rotation has been enabled, which has been talked about in the 1956 Act, but in the 2013 Act, this has been enabled. And there have been some confusion in the membership. So this is, again, the reference is there. Companies to which rotation are applicable, this is by virtue of Rule 5 of the Companies Audit and Auditors Rules. Unlisted public companies with paid-up capital of 10 crore or more. Private companies with paid-up capital of 50 crore or more. All companies except OPC, small companies, for them it's not applicable, having borrowings, public deposits of 50 crore or more. Only to these 3 types of companies. Listed companies we already seen in the slide, and these are the companies, and firms under the same network not allowed. For example, we know that, if we take KPMG for that matter, KPMG has so many member firms, or ENY has, say, Batley Boy, and PwC has, all Lowlock and Lewis, all those things. So the firm under the same network is not allowed. Partners resigning and joining other audit firm. So some of them use this very ingeniously planned method of resigning and then joining another firm, the firm getting the audit. So this is seen with disfavor, and this should not be. This will not be allowed. And so again, in that case, the provisions of rotation will apply. A 5-year cooling is also envisaged. Cooling is a term I'm not borrowed from the Companies Act. It is a term which we always use in the bank audit and the sphere of bank audit. And the central government by rules prescribe the manner of rotation. So this is how the much debated audit rotation and a long-term association impairs independence. Therefore, rotations have been therefore made mandatory for all listed companies and those companies we have just seen now. The members of a company may resolve to provide that the audit partner and his team shall be rotated. This normally happens in larger firms, mid-sized firms also. Some of us are still trying to make this happen at least once in 3 years or 2 years, as the case may be. And some of the clients will have a big discomfort, but this is an enabling clause for the corporates to say that the audit partner or audit partner A has been doing the audit for some time. Let a new perspective, a new understanding, a new way of looking at it come by requesting or rather asking the firm to make partner B in charge. And the audit shall be conducted by more than one auditor. So joint audit is also enabled. So may resolve, companies may resolve. It is an enabling provision. It is not a mandatory provision. So that's also relevant. So in the 1956 Act, joint audit, though it was done, there's no clear provision of joint audit in the earlier Act. Now, this is 139(5) subsection, if I remember correctly. Yes. The first auditor of a company shall be appointed by the board within 30 days registration. Now, there's a new thing has come. The MCA now insists that even for the first auditor's appointment, ADT 1 has to be filed. Earlier, it was not there. If not done, it shall inform the members of the company who shall within 90 days at an EGM appoint the first auditor who shall hold office till the first AGM. Irrespective of who appoints, whether it's a board or the EGM, the term of the first auditor expires at the conclusion of the first AGM. And thereafter, we have seen in 139(1), we have said that AGM will appoint an auditor for a period of 5 years till the conclusion of the 6th AGM, and thereafter for ensuing further 6th AGMs and so on. The first auditor of a government company shall be appointed by C&AG within 60 days. Now, this is surprising. If not done, the board shall appoint within 30 days. The board is given an power on C&AG, which I don't think is in good taste. And the board fails, it shall inform the members of the company who shall within 60 days at an EGM. So who are the members of a government company? So anyway, it is a provision which is enabling, and who shall hold office till the first AGM only. Now, C&AG appointments we are getting, in the case of a government company, for every financial year, the C&AG shall appoint the auditor within 180 days from the commencement of the financial year. So for the 2005-2006 audits, the 2005-6 audits, we have received appointment recently, and most of you have received because it is September 30th, they should appoint, but some with some delay. Ideally, we should have been appointed for 2005-6 financial year before 30th of September. Now, casual vacancy other than by resignation shall be filled by the board, within 30 days. So what if the board fails is not, the act is not specific. Vacancy arising by resignation, please take note, vacancy arising by resignation shall be filled by the company in general meeting within 3 months from the recommendation of the board. So the board has to first identify a new auditor to fill up the vacancy caused by resignation. Other than disqualification, death, all those things can happen in casual vacancy, but vacancy resignation is very touchy. Today in CARO 2020 also, if you're taking up an audit, filling up the vacancy of an auditor who has resigned, you're supposed to communicate with them and get representations, if any, and supposed to be reporting in the CARO 2020. So shall be filled by the company in general meeting within 3 months from the recommendation of the board. Casual vacancy in a government company shall be filled by C&AG within 30 days. There again, if the C&AG is lethargic, lazy, then the board is given an overriding power. The auditor appointed 139 may be removed from his office only by special resolution after obtaining prior approval of the central government. So this is what I said. So you appointed AGM, you appointed, and there was a case where we were asked to resign. And there's a very, I would say, the unjustifiable reason. We didn't want to cling on, but we wanted to enforce the provisions of the act. He said, "You remove us, we refuse to resign." And some other larger firm was wanting to get in because the terms of the engagement were very quite lucrative or attractive, and said we knew that reason, we smelled that reason, and finally we said, "You can remove us, we will not resign." And they had no option. They finally said, okay, they changed the thinking and came to us, but we subsequently we resigned for a different reason, and therefore the appointment is for 5 years, can be removed only by special resolution and with the prior permission of the central government. Make an application in ADT 2 to the MCA. And there again, the MCA will give options. You cannot just say that we don't want X, we want Y, or we cannot say that we don't want A, we want B. From out of the list given, you cannot just specifically say that one person X in place, Y in place of X has to be appointed. The auditor shall be given an opportunity of being heard. Principles of natural justice and equity and good governance. Because also they call it an unjust removal of auditors. The auditor should have some shields, some weapons in his armor to present his case properly. An auditor was resigned from a company shall file a statement with ROC or C&AG in the government company within 30 days, indicating the reasons and facts of resignation. ADT 3 and fees for non-compliance can run from 50,000 to 5 lakhs. The procedure for appointing a person or firm other than the retiring auditor remains the same. A copy of the representation shall be filed with the ROC. Now, it is not removal. He is, the person who is retiring. Ideally, this will happen because the firm can continue for 10 years, 5 after 5. And then if he's after 5 years, if there's a change, then I remember some of you would recall the provisions of Section 225 in the earlier act, and you have to give notice to the retiring auditor, and he can make representations of reasonable length, which has to be read out in the AGM. And if the notice have already been sent, if the notices are not sent, it has to be attached with the notice calling the AGM. And if it's too late, it has to be read out at the AGM, reasonable length. Auditor can make representations. It also says that the auditor misuses the opportunity to gain needless publicity for a defamatory matter. Verbatim. Gain needless publicity for a defamatory matter, then the company can decide not to circulate the same with permission from the tribunal, as the case may be. A 5-year ban is also envisaged if so removed. Here, procedure for, this is what we are talking about. And the tribunal may suo moto or an application made by the central government, excuse me, my charge. The tribunal is given the power. However, it doesn't say shall, on an application made by the central government or any person concerned. If it is satisfied that the auditor has acted in a fraudulent manner, direct the company to change its auditors. If central government is applied and the tribunal is satisfied that a change is required, it shall within 15 days order the auditor shall not function. He should be stopped from functioning. Removal can follow. And here also a 5-year ban is envisaged if so removed. That brings us to section 141, a very important section, disqualifications. Only a chartered accountant can be appointed as an auditor of a company. A firm where majority of partners are CS may also be appointed as auditors. So Companies Act seems to have seen this, foreseen MDPs in advance, multidisciplinary partnerships, and here where majority of the partners have to be CS may be appointed. And where a firm including LLP is appointed, only CA partners shall act and sign on behalf of the firm. This is a basic qualification. When it comes to disqualifications, body corporate other than LLP. LLPs are now not many of the firms as they grow in size, we are forming LLPs. And body corporates are disqualified. Officer or employee of the company is disqualified. A partner or employee of an officer or the employee of the company is disqualified. A person or firm who has direct or indirect business connection, business relationship with the company, its subsidiary company, its holding company, associate company, subsidiary of a holding company, as a fellow subsidiary, he's also disqualified. But business relationship, they have given a clarification. It says that the business relationship will not include or it excludes professional services given by a chartered accountant. Transactions in the ordinary course of a business by telecom, airline, hospitals, hotels, and other similar businesses. For example, having a Geo or a V connection does not disqualify you from becoming the auditor of Reliance Communications or the other telecom companies. You are a frequent traveler, so you have a jet setter card or something like that, an airline company, hospital health cards, hotels you regularly stay, so you have some loyalty or like the Hyatt dining club cards. So that does not disqualify you. Otherwise, having a close, business relationship directly or indirectly with not only the company, subsidiary, holding, fellow subsidiary or associate, they are disqualified. A person whose relative is a director or key managerial person of a company, disqualified. Who is in full-time employment is disqualified. A person, a firm holding the audit of more than 20 companies. This is where audit ceiling is enabled. Other than OPCs, dormant companies, small companies. Small companies, we are in a very dynamic environment. From 4 crores and 40 crores, now it is 10 crores and 100 crores. 10 crores of paid up capital and 100 crores of turnover. So recent notifications come, small company definitions they have enhanced. But let me also tell you, section 2, subsection 85 of section 2, the jointers and the paid up capital should not exceed 10 crores now, and the turnover should not exceed 100 crores. And means both the conditions have to be cumulatively satisfied to be qualifying as a small company, getting all these exemptions and relaxations. Private companies having paid up capital of less than 100 crores. For these companies, OPCs, dormant companies, small companies as defined under 285, amended from time to time. Private companies having paid up capital of less than 100 crores are not subject to audit. It is audit ceiling. It is notification 464 of 5th June 2015, more than 10 years old. A person who has been convicted for a fraud and a period of 10 years has not elapsed from the order. A person whose relative or partner is holding any security or any interest in the company or its subsidiary holding, we have said that all fellow subsidiary associate company, of face value exceeding 1 lakh, who is indebted to the company or a subsidiary holding associate, a fellow subsidiary for an amount exceeding 5 lakhs. Similarly, given guarantee to any of these companies for an amount exceeding 1 lakh. Any person engaged in any services provided under section 144. 144 is a ban, it's a prohibition on the auditor of a company rendering multidisciplinary services, which are the services we'll come to see when we come to the slide on 144. So these are the disqualifications under section 141. So if you are investing in shares of a company, be careful. It becomes very difficult for the company, for a listed company to find out whether this particular person is holding. Of course, register of members is found out. But what if a relative or a partner is holding? It becomes very, very, very difficult. Sorry. Remuneration, I say something which I always, when I address the membership, at large, we say that we are shy to bill and collect. The letter of engagement should essentially talk about the fees that should be agreed upon. Services should be delivered promptly, billed and collected promptly. Some people say that ours is the only industry which gives 12 months free credit. Insist on this year's audit fees being paid or previous year's audit fees being paid before commencement of this year's audit. This cannot happen. If the service is proper, if it's agreed upon, you should raise the bill immediately and get it promptly paid. Remuneration shall be fixed by the general body, general meeting, or in such manner as may be decided. All of you know that most of the time the general body doesn't decide. General body delegates that right and power to the board to be fixed in consultation with the auditor. The board may fix the remuneration of the first auditor because the board is appointing the first auditor. And in case of C&AG, yes, it's a C&AG gives the power. Again, it is delegated to the company. Earlier it was fixed by the C&AG. Now appointment by the C&AG and the right and power to fix the remuneration, they have given back to the companies. That brings us to the most important section. Powers and duties of auditors. And look at that. In the very caption of the section, they have used auditing standards. Day before yesterday, I was addressing a branch in Kerala, standards on auditing in the wake of peer review. Membership is largely unaware, or I would say oblivious, purposely or not, about the applicability of standards on auditing or auditing standards as it is used here. Let me tell you, it is not just for large corporates. It is not for the suit boot army. Auditing standards or standards on auditing formulated by the ASB are now mandatory under the Companies Act, but they are applicable whenever there is expression of opinion. So imagine a Form 3CB, which is a non-corporate tax audit report. The last paragraph, we are saying that the financial statements give a true and fair view. The moment you use the term true and fair, it is expression of opinion. And wherever there's expression of opinion, all the standards in auditing, there are no partial or total exemptions. All the standards in auditing will apply in toto, in entirety with full force as it would apply to a Reliance or an Infosys or any large corporate. I'm talking about anyone who's sitting in a small town, in the official areas who are doing non-corporate tax audit, standards in auditing are mandatory. And I was discussing this in the wake of peer review. Peer review is going to hit all of us, but the last phase has now been deferred. For firms doing the branch bank audit or firms having 3 partners or more, they're supposed to get peer review done by 1st Jan 2026. We have come 15 days past that deadline. Our dear friend Purushottam Lal Kandalwalji was here in Cochin and said there is going to be, at that point of time, 2 weeks back, he said, we are considering an extension and now it has been extended to 31/12/2026. 12 months extension has been given. But let me tell you, there's a scare about peer review being there. It's because we are a little passive about the mandatory pronouncements of ICAI. It is painful at times. I was fortunate to serve as a member of the ASB 20 years back in 2005, where we had legends like late Rahul Roy, who later became president of ICAI. He's not with us anymore. Under the chairmanship of Amarjit Chopra ji, or former president Amarjit Chopra ji. And it was, again, T.N. Manoharan sir who co-opted me to the ASB in 2005. So I have seen the deliberation, the work which goes in there. As I complimented the secretary at CLCGC, the same is the case with the ASB. In the standard formulation, looking at the best practice across the world and formulating standards, updating them, revising them, bringing about the required literature, non-mandatory guidance notes, keeping in mind the implementation guides which are coming so promptly, with acting with so much of alacrity, but the compliance levels are dismally poor. So the Companies Act now has said in 143, it was contextually that I took a short detour, and I'm coming back to 143, which is a very, very important section. One has to read, understand, and apply. As I said, let this be injected into us, every one of us as part, let that become a work of our, part of a work DNA, nothing less. So to exercise the powers, exercise the duties, the auditor should have his rights. So logically, he has a right of access to books of accounts and underlying documents. Instead of vouchers, I think high time that we started using the term source documents. Makes sense and adds credibility. Right to require information from officers of the company. And rights should apply to subsidiary too, insofar as it relates to consolidation. These are very important rights of the statutory auditor. Now, when it comes to duties, or the auditor shall make a report on the financial statements laid before the AGM, duly taking into account, the section says, applicable provisions of the Act and the allied rules, accounting standards, auditing standards, and matters to be included in the auditor's report under the Act and rules. The auditor shall report whether the financial statements give a true and fair view of the affairs, profit by loss, and cash flow. The cash flow statements also have become included in the definition of GPFS, General Purpose Financial Statements. 2 subsection 40 of the Act says financial statements include balance sheet, P&L or income and expenditure account in the case of a Section 8 company, cash flow statements, and the SOSE, statements or changes in equity. SOSE is now applicable only for India's companies. But cash flow is applicable even for smaller companies. But small companies, again, are exempted from the preparation of cash flow statements. But let me tell you, in advising management, in managing our own organizations, cash flow is of substantial importance. And the future of financial reporting is going to be circling around the cash flow, not against P&L. You may have made a profit, but where is the money? Have you collected it? Are the receivables going to be bad or unrecoverable? No, then it's a huge challenge. And I remember I got a very renowned speaker with whom in 2010 I presented a paper in Muscat in the Sultanate of Oman, where his presentation was on cash flow statements. So he asked this question: why do we need cash flow statements? So we had multiple nationalities sitting there: Omani, Sudani, Pakistani, Malaysian, Sri Lankan, Indian. The mixed responses. But this next slide was very, very appealing. Turnover is vanity. Turnover is vanity. Profit is sanity. And cash is only reality. And hence cash flow statement. Very appealing. N.R. Narayanamurthy famously said, profit is often opinion, but cash is reality. So I'm highlighting on the importance of preparing cash flow statements, and which is not spoken about, which is not part of the 56 Act today. There is newer areas, newer thrusts on things which are important from a governance point of view, from a financial management perspective as well. Now, powers and duties of auditors, I have 143 sitting here with me. All those, the auditors shall inquire. Initially talks about the auditor, amongst other matters, inquire into the following matters, namely, whether loans and advances made by the company on the basis of security have been properly secured, transactions of the company which are represented merely by book entries are prejudicial to the interests of the company not being an investment company, whether securities have been sold at a loss, price less than they have been acquired, loans and advances have been shown as deposits, personal expenses have been debited, charged into revenue account, and the shares have been allotted for cash, whether cash has been received, etc. This is there in the old 227 also, but I have not reproduced that. But then there are new things which have come. That was where the amongst other matters, inquire into. So 143.1, the auditor shall inquire into and report if only the findings are negative. But 143.3, when it comes to the auditor, this report shall also state. That is where it talks about here. 143.2, we have report to the members of the company and talks about true and fair and all those things. Very important, that one. Said accounts, the financial statements give a true and fair view of the state of affairs as at the end of its financial year, profit or loss, and cash flow for the year ended, and such other matters as may be prescribed. All these prescriptions, where do we find? Under the company's Audit and Auditors Rules 2040. 143.3, these are the new items which have any qualification or reservation, adverse remark relating to the maintenance of accounts and other matters connected therewith. This is a added point, because in the main body of the report, I hope all of you recall that whether the books of accounts as required by law has been maintained by the company. We are already reporting, but it's added trust. Adequate internal controls and system in place and its effectiveness. Not new in the Act, it has come, which is not additional items as compared to our old practices. And such other matters as may be prescribed. I have a hyperlink here as well. Whether the company has disclosed the impact of pending litigations on its financial position and the financial state. The pending litigations can be of huge financial impact. We have NOCLAR for listed companies, those who are familiar, non-compliance with laws and regulations. We also take guidance from SA 250, Standards Noting 250, consideration of laws and regulations in an audit. That's all very important. So this is a very specific reporting requirement in the auditor's report. Whether the company has made provisions for material foreseeable losses on long-term contracts, including derivative contracts. Your open derivative contracts, or even if you look at accounting standard 7, construction contracts, if you, through a 5-year contract, in the second year, if you feel that the contract is ultimately going to end up in a deficit or a loss, that has to be calculated based on estimations, and the loss has to be provided for in the second year when that new enlightenment comes. So foreseeable losses, materiality is key. Material is the basis. SA 320 on standards noting tells us. I've been frequently addressing, almost every month we have programs. AISB is doing online refresher courses, again under the leadership of another dear friend, Sripriya. And a lot of programs where I said 320 I've been frequently discussing on fixing materiality levels and all that. So materiality is key to accounting and auditing. So this is very important, whether there have been delays in transferring amounts due to be transferred to IEPF. So these are the matters which should form part of the auditor's report. And moving on, this is a very, very important thing and highlighting the need for complying with standards norm. Let's take 1 minute to dwell back into the history and evolution of accounting standards and auditing standards. ICA was set up in 1949, and it was in 1977, so many years later, that the ASB was set up, Accounting Standards Board. 5 years later, in 1982, the APC was set up, Auditing Practices Committee. It is now renamed as AASB, like the IAASB, International Auditing and Assurance Standards Board. And people sometimes used to make fun of the auditor saying that, boss, look here, your institute has formulated accounting standards and auditing. You comply, otherwise you will be in problem. But they're not binding on me. In Bangalore, as a senior articles assistant, I had to face this scorn and disregard by a non-CA belonging to another profession. I didn't have any ammunition to defend. I was feeling bad. But in 1999, in the Companies Act, Old Companies Act 211, 3A, 3B, 3C was inserted to make accounting standards mandatory for corporates. Auditing standards still were not mandatory. So 2013 Act, it was enacted. 133, we have just seen 15-20 minutes back, 133, the central government has prescribed all the standards formulated by ICI. I say that with pride, and I say with emphasis that formulated by ICI, nobody else. And we have been doing that sensibly well for so many years. Now that is being suspected, doubted, and that foundation is being shaken, which is very disturbing. So then 133 is prescribed. And in 143, you made it very clear, the statute book is now very clear that every auditor shall comply with auditing standards. Now it brings us on a huge additional responsibility. The consequences, the differences, till 13 Act came, standards and auditing were mere dictums of the institute on its membership, you and I. But today it is part of the law book. The MCA can, the NAFRA can, regulator can have direct recourse on you without going through the disciplinary mechanism of the institute. This made us more vulnerable. So we have to be extremely careful, making sure that we comply with all these standards. So in a disciplinary proceeding, there's a very impersonal question. Mr. CA, have you done the audit properly? Yes, sir, I've done the audit properly. I've been doing it for 20 years. Give us your engagement letter. Show us your audit program, SA 300. Audit planning memorandum, SA 300. Show us your files, documentation, SA 230. Documentation today doesn't mean the thick box files we used to have. Digital documentation is fine. Electronic documentation is fine. So here is very, very demanding, challenging section, one single line, every auditor shall comply with auditing standards prescribed by central government, recommended by ICA. We still say formulated by ICA in consultation with NAFTA. And in the very caption of the section, powers and duties of auditors and auditors. But we are very passive about this. We are disregarding this. So I always say that there's a huge change in the given environment to have a revolutionary change in the work culture of every audit firm, well-meaning audit firm, for whom governance matters, for whom growth matters, for whom compliance with the regulations and laws of the land matters, who want to be respected and looked upon as firms who can be appointed for complex assignments. Now, this is 143.12. If the auditor has reason to believe that an offense involving fraud or being or has been committed by officers or employees of the company, he shall report the same to the central government in the manner prescribed. But if the magnitude, the amount involved is less than a crore, it is sufficient to report to the company. In larger cases, you first report to the board audit committee seeking their reply within 45 days. And then report to central government with such replies within 15 days. So put together 60 days in Form ADT4 to MCA Secretary in a sealed envelope as RPID, Registered Post Acknowledgement Due. 143.12. Branch office is the same thing. Branches have to be audited by a CA or either by the company's auditor, principal auditor himself, or by the qualified to be appointed as company's CA, company's auditor. Branches abroad may be audited by a person qualified under the law of that land, and he shall submit his report to the company's auditor. He too shall report under fraud under 143.12. Fraud reporting responsibility is there on the competent auditor also. If a fraud happens at the branch or a remote location, branch office. So that brings us to the end of 143, but we discussed that in less than 10 minutes. But that calls for a pause, a deep introspection, and a course correction if needed. This is a ban on, say, 144 is a ban on the auditor of the company, not statutory chartered accountant. Me as a chartered accountant can render any kind of service to a company which I'm not the auditor. A company in Chennai or in Indore or in Delhi, I can be a consultant. I can do accounting services. I can do project reports, of course. Examination of prospective information, SAE 3400 is a different story. So an auditor shall not render, the statutory auditor of a company shall not render following services to a company, its holding company or subsidiary company, directly or indirectly. Indirectly has got a huge meaning, huge impact. Many of the audit firms have been having associate firms and doing this kind of services. So one has to be extremely careful about that. Accounting and bookkeeping is prohibited. Internal audit, the statutory audit internal cannot be the same. Design and implementation of financial information systems, including technology assistance, actuarial services, investment banking, investment advisory, outsourced financial services. Now, CFO services has become very common now, but if you're the auditor, you cannot. Management services, there's a broad definition of management services. Attestations, there are no prohibition. Tax representation also, it has been clarified that you can. Any other services as may be prescribed from time to time. So 144.1 has to be clear. So normally what happens in a medium-sized private limited company, if it is from a non-group, maybe a friend from college days, runs a company and he knows that you're practicing, he belatedly comes to know that you're a practicing CA and he wants to shift the audit to you. So we said all that is required to be done. In the appointment, as we have seen, 139 should be complied with. And then you also want you to do, you please take care of everything. You be my auditor, you be my tax consultant, you be my financial advisor. So periodically prepare project reports or prepare a CMF form or working capital assessment. You do the GST returns, you do the ROC filing, MCA filing. You do the TDS quarterly filings. act with care. So any other service has been prescribed. So 144 has to be see very carefully. 145 is about signing the report. The person appointed as auditor of the company shall sign the auditor's report in the accordance with the provisions of 141(2). Comments having an adverse effect on the functioning of the company shall be read in the AGM and shall be kept open for inspection. Auditor to attend AGM. The auditor shall, unless exempted by the company, attend the AGM personally or through a qualified representative. Qualified representative has to be a CA. All notices of general meeting should be sent to him. He has a right to be heard on matters concerning him as auditor. So sometimes it becomes important and sometimes it becomes essential, I would say, to attend the AGM and explain your points. So the board would request sometimes. Most of the time you can see. But for any reason, if you're not able to, then we accept it. Now, if you want, when it comes to 147, if it talks about the punishment for contravention. So if any of the provisions of 139 to 146 contravene, this is for the company. But the auditor who's of our non-complying with 146, there is no penalty on the auditor. That is good news. Any of the provisions of 139 to 146 is contravened. 139, appointment of auditors. 140, removal. 141, qualification, disqualification. 142, remuneration. 143, powers and duties of auditors. 144, the auditor cannot render multidisciplinary services. And 145, we have seen signing the auditor's report. 146, attending the AGM. Any of them are contravened, then the company shall be punishable with the fine of 25,000 to 5 lakhs. And the MCA is very merciless now. They are levying penalties for not using sin on the letterhead, not mentioning sin on the letterhead. And let me tell you, though we have skipped that section, CSR has become painfully punitive. The penalties which are being levied for non-compliance with 135, 5 and 6 are very, very disturbing. And now the entire system, the entire regime of CSR is under revision now. It is being finalized. The threshold of profit is being brought down from 5 crores to 3 crores. And I would also like to remind you that that profit, which is mentioned for CSR 135, is PBT and not PAT. It's profit before tax. So become applicable, and then you have to spend on CSR, go ongoing projects other than ongoing projects. Failing, we have to transfer to funds which are mentioned in Schedule 7 and so on. A lot of things which we can discuss there. Every officer is imprisonment for 1 year and or fine up to from 1,000 to 1 lakh. This is for non-compliance with the provisions of the other sections 139 to 146 of Chapter 10. If willful, he shall be punishable with imprisonment of 1 year and a fine of 1 to 25 lakhs. He shall refund the remuneration. It's about the auditor. Shall also pay damages to the company authorities for loss arising out of incorrect reporting. Now, our country has not become very litigative on audit failures or audit lapses, which result in corporate failures and the investors, the stakeholders losing money. But it's not the case in the West. There are a lot of multi-million litigations being taken up against large audit firms, and they're fighting it at every court of law and regulatory authorities. So one has to be extremely careful. As I mentioned in the beginning, we are in a very, very regulated, supervised environment, and everything has to be done taken with a pinch of salt. And the auditors today trained in SA 200 in the new preface, they have used the term professional skepticism. It has become very vocal and very pronounced, that the term professional skepticism. So one has to be extremely careful. Partners form to be responsible jointly and separately, and fine can run from 25,000 to 5 lakhs. This is 147. Now that brings us to the last section, 148, is for cost audit. The central government may direct cost audit of certain companies. There's a new thrust on cost auditing standards. Auditor is statutorily disqualified from doing the cost audit. Cost auditor should submit his report to the board, who shall forward the same with explanations for reservation to the central government within 30 days. So cost audit is now applicable. The provisions say that notwithstanding anything contained in this chapter, the central government may, by order, in respect of such class of companies engaged in the production of such goods or providing such services as may be prescribed. This is direct that particulars relating to the utilization of material or labor or to other items of cost as may be prescribed, again in Rule 3, shall also be included in the books of accounts kept by that class of companies. This is about cost records. And cost audit, when it comes to cost audit, every company specified in item A, regulated sectors of Rule 3, which means that every company which is required to maintain cost records under Rule 3 shall get its cost records audited in accordance with these rules if the overall annual turnover of the company from all its products and services during the immediately preceding financial year is 50 crores or more, and the aggregate turnover of the individual products or services for which cost of this is about 50 crores on an individual 25 crores. Cost records again not for everyone. Cost records also they say and services rupees 35 crore or more during the immediately preceding financial year shall include cost records. Out of those companies which are required to maintain cost records, cost audit is applicable to those companies where the turnover is 50 crore or more, and for which cost records are maintained to be rupees 3 under Rule 3 is rupees 25 crore or more. This is the requirement of cost audit, and there are exceptions also. Exemptions are given. Revenue from exports in foreign exchange exceeds 75% of the total revenue. If your earnings of the total revenue of the turnover 75% is in foreign exchange or other exports, you are exempted. And units exempt. So these are the provisions of 148 and the related rules. Cost records and audit rules 2014. So in about 1.5 hours, I have endeavored to touch upon the important provisions of the Companies Act relating to accounts and audit. We started just to have a recap. We started off with an introduction, a brief introduction, the takeoff introduction by the chairman, C.A. Babu Abraham, and of course, very objective and focused opening remarks by C.K.P. Paulson. And we took off with this and started off with accounts of companies 128 to 138, in which we have skipped 132 and 135. It is NAFRA and CSR. CSR, we can still have a discussion, brief discussion, but the entire provisions are under revision now. So it may not make much sense because if at all we learn something new now, it has to be unlearned and then relearned. So with that, we also covered 138 internal audit. Moved on to chapter 10, audit and auditors, starting 139 appointment and so on, and had a lot of emphasis on 143. And we had hyperlinks on to various things like audit rotation, internal audit applicability, all these things we have seen, and cost audit. Finally, we concluded with cost audit. So these are the points and important provisions as far as accounts and audit are concerned. So any chartered accountant is doing at least one company audit should be absolutely familiar with all these provisions. And the Companies Act 2013, as I said, is still evolving. It's a dynamic environment. So earlier on, we used to have the glittering Ramaya still sitting in my shelf. All the 1956 Ramaya sitting in my shelf, call it. Now, this also we bought when the Companies Act 2013 came. This is the Companies Act 2013. This is I'll call it the blue wrapped version of Companies Act 2013. So there's a lot of companies in there, but due respect, I would say that today, the safest way of referring to Companies Act 2013 is to go to the MCA website, mca.gov.in, and go to the ebook the Companies Act 2013, which is the most updated version, and it is administered and I think it is maintained by ICSI. And big changes happening, amendments happening, good links to what is the entire chronology of amendments ever since 2013 till the very recent date. We'll get it there. So whenever I do a session on the Companies Act, always urge the members, the practicing members particularly, to refer, even the company secretaries, wherever we interact in larger corporates, ask them to refer only the ebook. And then we can take downloads. You can call out a particular portion, a section or entire chapter, section wise, and have a folder in on your desktop. But that has to be refreshed maybe in the given environment, refreshed as frequent as every month, if not every week. That is how things are changing. So let me conclude thanking every one of you who are online with me. The good number of members. This has been a good opportunity to interact. And also when Chairman C.A. Babu Abraham contacted, I was a little reluctant in the sense that recent updations have not been made. Then I took it up as an opportunity. Let me take this as a challenge, update myself to do some homework and bring up with the latest changes. I hope I haven't missed anything, but if there are some inputs from the participating members or the CLCGC, I would be really happy to be enriched by the collective wisdom of the members here, the resources that you have at CLCGC. So with that, let me conclude wishing you all the very best. All the members here, we are only 16 days into the new year. So 2026 is still a baby. And a lot of things we can resolve to make 2026 a better year, a happening year. I would conclude quoting Arvind Datta, who was a speaker at the Southern India Regional Council. He was given a topic called Scaling the Peak. And how he has progressed, everyone knows. It is an enviable story. It is a very story which makes us proud as chartered accountants. So Dattaji said, in a relevant part of his speech, he said, presentation, he said, in the next 4 weeks, I will complete 7 decades of my life. I repeat, in the next 4 weeks, I'll complete 7 decades of my life. I thought to myself, what to do? Retire, sit back, relax. He beamed on to me, and I made a firm resolve to do much more things in the next 15 years than what I did in the last 45 years. That gave goosebumps to me and many of the people who were there and inspired by the way people look at life. If you feel that it's time to sit back and relax, a lot more things which we can do. And in that process, be useful to the society and the nation at large. Wish you all the very best. Thanking all of you at CLCGC, and a special big thank you to Babu Sir, C. Babu Rangallivel, for this opportunity, and to Paulson Sir also. So let's stay connected. I'm okay. I'm home. I'm allowed that my contact number and my mail ID. I always feel that professional interactions, asking questions, raising doubts is the way we learn. So as a teacher for last 20 years, having touched more than 10,000 CS students, I keep seeing that it is an intelligent, inquisitive student who makes a good teacher, keeps them learn more, think more, and act more and be more. God bless every one of you. Thank you so much. It is back to the organizers.
Any questions from the participants?
Yes, sir. The questions has been sent in the chat box.
Yeah, let me see.
Yes, sir.
Paulson sir, would you like to one brief summary about the changes brought by the Act and rules, even you can give a gist of it? What are the important provisions applicable in accounts and audit in respect of mining company? Mining company, to my knowledge, the gist of changes, I would suggest that I would request CLCGC to share the slide deck with the members who have attended this program, if that is the normal practice, which is updated version as far as my knowledge goes. I've done some homework and done some updation. So that is a brief summary. You will get it from there. You can start updating from there. That's my suggestion. Sir, Paulson sir, would you like to read out or can I go on?
Yeah. You can go on.
What are the important provisions applicable in the accounts and audit in the respect of mining company? To my knowledge, specific provisions, not they were cost records would apply. Other than that, I don't see anything specifically mentioned for mining companies. You have when it comes to the mining rights, if it's the mining rights and all that, you have the applicability of the wasting assets in accounting standards. All those things you have to be careful. If the company's profit is more than 3 crores in the preceding year, whether provisions of CSR is applicable to the company for the year ended 31/3/26 and onwards. As of now, no. But then that is the way they are amending. The threshold on profit is 5 crores. I mentioned PBT of 5 crores is being reduced to 3 crores to bring more corporates into the bracket of or the ambit of CSR. But as of now, no. We have to wait for the final notification. Yeah, you are right, because it's always with reference to the previous year. 135, when it was originally enacted, it said if the profits, etc., of a particular year exceeds. Then they found that by the time the year is already over. So they went back and amended, if the profits, etc., of the preceding year exceeds the thresholds, then that company has to apply. Like you said, it is with reference to 24-25 financials that we decide on the CSR obligation of 25-26. For the year ended 31/3/25 earlier years, it was 5 crores. In this case, what happens? Yeah, I hope I have answered the question. What is interest on corporate loans? Not getting the question clear. So maybe you're talking about intercorporate loans. Yeah, you can have intercorporate loans subject to from both sides, section 185 loan to companies in which directors are interested. And here the entire chapter 5 and section 73, where you can have intercorporate deposits subject to all that. I think acceptance deposits, intercorporate deposits are exempt. And the company which is taking the loan can pay an interest to the other corporate from which the loan is taken. TDS would surely apply. And the reasonableness of interest, the auditor will have to also report. Is there any changes in the Schedule 6 report? So Schedule 6 is dead long back. Schedule 3 is what we refer to. So please refer section 129 and Schedule 3 of the Companies Act 2030, where you have 3 divisions. Division 1 is for companies for which accounting standards are applicable. Division 2 for Ind-AS companies and Division 3 for NBFCs. Schedule 6 was part of the Old Act. After signing the auditor's report, but before AGM, the auditor becomes aware of a material related party transaction not disclosed in the way, can the audit report be withdrawn or revised? It has not been after signing the auditor's report, but before AGM, the auditor becomes aware of a material related party transaction. It has not been placed in the AGM. It has not been sent to the auditors. I mean, I am assuming that it's not sent to the shareholders. So there's a guidance note on revision of auditor's report. It is allowed. It is allowed. We have to make it clear, and related party transaction can be disclosed. It has to be done. It is possible.
Paulson sir, I have posted a few questions in the chat box.
Yeah, Levin, I'm going into that. No, I'm Jomon here. Who is this? Nikita?
Yes, sir. Yes, sir.
Yeah. Paulson sir, I took his permission to hit the
Yeah.
questions directly. So
You
with
can
the
Okay, sir. No
permission.
issues. Okay, sir.
Now the second portion, that is query 11. Company maintains books of accounts on cloud-based software controlled by a third-party vendor. Auditor is given only access to download restrictions. What are the practical safeguards an auditor should insist upon? Auditor is given view-only access with the download restrictions. That is a limitation on the scope of the work. So that has to be seen with a lot of care. And how do we say that we have obtained all the information and explanation given to us? We should be able to have copies of reports, not the entire, like what's happening is smaller companies send the entire tally data to our mail ID. Sometimes they send it even to the student's mail ID. But then here, we don't need to have the entire data. So view only access is fine. View only access is that final reports like trial balance, a duly authenticated trial balance and things like that, you must insist on. Failing which, you may have to go for a modification. The technology is fine, but then that doesn't mitigate or deviate our responsibilities. AGM is fixed and statutory audit is complete, but management wants to defer adoption of accounts due to ongoing tax litigation impact. Yeah, AGM can be adjourned and AGM need not adopt the accounts in the first AGM. It can be adjourned for the reason. Despite a good internal control framework, auditor notices the frequent management override entries in the year end. How much documentation is enough in practice? Strictly speaking, this is not a question on Companies Act 2013. This is a question on auditing standards. Management override of internal controls. I would invite your reference to SA 315, Understanding the Entity and its Environment, Mitigating Audit Risk, and documentation override, management overrides, whether they have an impact on the financial reporting. One has to very objectively evaluate. And based on that, only finally, there is enough for something which we always talk about. When it comes to evidence, the term used is sufficient, appropriate. So sufficiency talks about the quantity and appropriate talks about the quality of evidence. So one has to do it very carefully. In fact, in the ILNFS debacle, when NAFRA came out with its report, 305-page report, the crux of the report was, one was that the firm did not exercise the required level of professional skepticism. Two was they did not obtain sufficient appropriate evidence. So good internal control framework gives us a lot of comfort, but overriding management authority use would sometimes dilute the robustness, effectiveness of internal controls, and auditor has to take it with a pinch of salt. Auditor suspects fraud but lacks conclusive proof, practical risk of over-reporting versus under-reporting. Please refer SA 240, sir. We'll see, do not have time. How the auditor should deal with suspected instances of fraud. I can conclude it like this. Whenever he smells the rat or suspects of fraud, he should do deeper dives, more extensive substantive procedures, deeper dives, as the new generation says, deeper drills, until he's able to either confirm that there's a fraud or dispel that doubt. That is something I can say, but SA 240 gives you guidance. Standards noting 240. Trial balance keep changing till last day. Every change impacts earlier audit conclusion. When to draw the hard line. So take all the conclusions you have taken and look at the final trial balance, the entries pass. No, you say that, okay, we use something called the EPL, entries pass list in our office. So you take the final trial balance. First trial balance, you have trial balance 1, 2, 3. It happens everywhere. You are not alone, sir. So then based on the final trial balance and the entries passed, you objectively evaluate. During casual discussion, audit learns that a major customer is a director's brother, but no disclosure existing in records. How does the auditor convert oral information into audit evidence? Now, if you have clear evidence that you should insist the management that it should be disclosed. It cannot be based on a hearsay, but you are convinced that a major customer, so they are supposed to maintain a register under section 189. 188 is related party transactions under the Companies Act 2013. 189 is the register. The register you are saying that is not there. Also refer SA 550, related parties, how to deal with that situation. And I think you must insist on that being disclosed. After signing the auditor's report, the auditor discovers an undisclosed RPT through MCA data or third-party information. Auditor's exposure if no action is taken. I think we already mentioned in the earlier question, that particular question has already been. Is this provision for 5-yearly appointment practical to government companies as well? It is not. It is not. It is normally the C&AG appoints for a lesser term. So for government companies, it is the C&AG. A 5-year is not applicable. Can we file ADT1 for appointment first audit to private company voluntarily if it is possible or not? Sir, first auditor, it is recently required that recent requirement that it is to be filed, ADT1 has to be filed for the first audit appointment by the board. It is a responsibility of the management. There is no fees, therefore, if the management is okay, you can file on behalf of the management. Nikita, I think I have exhausted all the questions. Probably we can wait for some more time. We have 10 more minutes to go. If there are more queries, I'm only happy, and I'll attempt to give from my experience and my understanding of the act and the rules.
Yes, sir. Yes, sir. Very well explained. And thank you, sir, for addressing those queries and so comprehensively and for sharing your valuable insights. I,
I think you have the moderator may have to make us closing remarks.
Sir Paulson, sir,
Yes,
is there?
Joman.
Yes.
Yes, Joman. It was a wonderful session. You
Yes.
have covered the entire gamut of the relevant sections in the Act. I think there is nothing more to add within this short span of time. And anyway, what you have said, that 143, any amount of explanation will not be suffice to tell our participants the gravity of the situation, the compliance requirements, and the regulatory expectations expected out of us. So I think you have done a good job, Jaman. As usual, we are really delighted by your sharing of knowledge. Thank you very much.
Thank you, sir. I'm flattered, but at the same time, your compliments brings on me a bigger responsibility for doing even better. Seek your good wishes. Seek your good
Thank
wishes,
you.
all of you participants. Thank you so much.
Yeah.
Uchiyo, Nikita.
Thank you, sir. I extend my sincere gratitude to all our distinguished speakers for sharing such insightful perspectives on the Companies Act 2013 focused on accounts and audit. Your expertise has truly enriched our understanding of this important legislation. We also thank all the participants for joining us and actively engaging in today's webinar. Your presence and enthusiasm greatly contributed to the success of this session. We remain committed to bringing more such meaningful knowledge initiatives, and we look forward for your contribution and the regular support. Thank you, sir. Thank you once again. Thank you all.